This year has seen the intensifying of the debate, which in some sense has been going on for years. That's a continuous debate. Are we at the end of the bull market of stocks? Is the recession imminent, or is it some time away? But my point is that when you look at things, how you've traded through them, looking for recession is way too late. By the time recession happens, it's way too late to look for recession. So it is a time to be patient, liquid, conserve your capital, and look for big payouts, but over the long run. I started working on Wall Street in 1997, and over these 20 years, I have seen two major business cycle rollovers. When I talk about historical patterns of what happened in the markets and how various things resemble to me, I can draw on this experience. All of us can look at the charts, but there is something different about actually having traded through the market and having a feel for how things actually traded. What were the perceptions? What people felt? This year has seen the intensifying of the debate, which in some sense has been going on for years. That's a continuous debate. Are we at the end of the bull market of stocks? Is the recession imminent, or is it some time away? I think no one actually says that there will never be a recession. It's like the bears just keep recession postponed a little bit. And I think recent tax cuts and the fiscal stimulus push the recession back, push that business cycle further into longer bull market territory in many people's minds. And the recent volatility of 2018 has intensified the debate. Are we late cycle? Which I don't think many people think that we are on the doorstep of recession. I will talk more about this later. But is recession imminent in a sense, like are we a year away from it, or are we 5 years away from it, or 3 years away from it? Which essentially is a question, are we mid-cycle, still ramping up growth, still will see significantly higher stock market, see a few more years of good GDP, or are we like in the last throes of the cycle? And I was pretty agnostic about where we are until maybe the end of last year. I might have slight biases, but they were not strong biases. I think towards the end of this January, I received a strong signal in my system that we are in the late cycle. And since then, over the last few months, I had a lot of direct and indirect confirmations, which made me shift my thinking and timing of my trades fairly dramatically. So market participants have each their own signals that they prefer. Everybody can read GDP numbers, everybody can read unemployment, various prices and charts. But I think most macro practitioners like to think that they have some area in which they have an edge, something that they do better than anyone else. And my edge.
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description. Go to realvision.com and see what you think. We look forward to seeing you there.
Most macro practitioners like to think that they have some area in which they have an edge, something that they do better than anyone else. And my edge, I believe, what I do better than anyone else is this understanding of the concept of concurrent necessity. And this refers to when there are two market events you can consider, but one of them concurrently necessarily causes another. And I will explain it. It might sound a little confusing. Let me put it the other way. The way it means is that if by the time A will happen, B will have to have happened, which makes B valid in more broad range of economic outcomes. And as an example of this, when we are in mid-cycle, early recovery, what I call the recovery skepticism market regime, a rallying stock market becomes a concurrent necessity with respect to rising interest rates. Let me explain why. What happens is that when we're early in the recovery regime and inflation is still low and there is no real inflation fear, Fed will only raise rates if stock market does well. And in some sense here I'm using stock market as a proxy for asset prices in general and maybe even economic performance to an extent in general, even though it's not exactly the same thing. Early, when we go back to 2011, 2012, 2014, Fed will not raise rates unless stock market is doing well. But even if stock market is doing well, Fed may not raise rates anyway. So betting on higher stock market is a much better trade than betting on rising rates. Towards the end of the cycle, we switch to what I call the inflation, from this recovery skepticism regime to inflation fear regime. And in my book that I wrote in 2014, I described this regime in detail as pertained to 1999-2000. And this is where I saw the late cycle signal, the uncanny resemblance of the market trading regime of the winter of 2018 to the winter of 2000. What arrived in 2000 is the regime when inflation numbers are high and people are really scared of the rise of inflation, and short-term rates going high becomes the concurrent necessity with respect to stock market going up, which means that unless stock market crashes, the Fed is going to keep raising rates. But basically the Fed is tightening in any normal economic performance. But they may even keep tightening even during stock market volatility. And if we remember the regime of 2000, the stock market volatility arrived early in 2000. However, the Fed tightened all the way to close to mid-2000, and even the light tightening hike was actually 50 basis points. And it took them less than a year, just a few months after that they had to do an intermediate easing in January 2001. So that last hike, not necessarily, it was not a stock market top, but it was already a period of stock market volatility. This is the sign of end cycle. And the logic behind is that at this point, stock market becomes self-defeating. If stock market goes up, it causes rates to go up, which causes tightening of economic conditions. So stock market cannot create easier financial conditions by itself because it immediately gets offset by raising rates. And that creates this negative feedback mechanism in the end cycle, which stems growth outlook. When you're making market forecast, it is very important to understand what exactly you're looking for. When people analyze past recessions, and this is where, by the way, what I talked earlier about trading through markets versus looking at them historically comes in. People look at all sorts of things and say this has or has not happened before recession. For example, people say recession never starts until XYZ happened. But my point is that when you look at things, how you've traded through them, looking for recession is way too late. By the time recession happens, it's way too late to look for recession. Somewhere about 6 months before recession, it's already clear that the recession is going to happen. For example, recession didn't start till sometime in 2008, but the first financial shock arrived in the first seize-up of financial markets arrived in 2007. Similar recession didn't start till somewhere spring in 2001, but severe economic slowdown became apparent in the end of 2000 and severe correction and NASDAQ and all this stuff. So that is really what we have to look for as traders. We don't care on what month recession happens. What we care is what are the signs of arrival of that period, because we don't want to be, by the time stock markets are 30% down, we already missed something big, right? Even if recession hasn't started yet. So what I started to look for is various things that happen during recessionary conditions which lead towards recession, and what things happen before those conditions decisively form. As I said, it was precipitated with me receiving my system-specific signals, but I started to look at other patterns that occurred over the last 2 cycles. What I find particularly interesting that there is a large number of patterns of price actions that people use to argue that we're actually in mid-cycle, that the economy is strong, but all of those things have been present at the end of the last 2 cycles. I will start with one which was particularly interesting and decisive, is the price action on oil. What we currently have, oil made a low, a very significant low a couple of years ago, and that's been running very strong. And many people argue it as an argument for inflation or indication of strong global growth. But if you look at the previous 2 cycles, oil did exactly the same thing. It made a low, a local low 1 or 2 years before the recession arrived, and was strongly running up right into recession. It is actually a very, very distinctive pattern. By itself, and here, just as with everything else I will say further, the rise of oil price itself is not an indicator of recession coming. Very often it goes up and the recession does not come. But it is consistent with late cycle. Like current price action on oil is consistent with late cycle. So what are other things that what are consistent with late cycle? One of them is the arrival of stock market volatility. And what is interesting is that when this volatility arrives, like it did in January of this year, end of January of this year, or it arrived in March 2000, or it arrived in July and August of 2007, neither of those actually marked the absolute top of the stock market. For example, NASDAQ even this year made another high recently, I think in March. Similar, the stock market highs were actually December 2007, much closer to actual recession. So this arrival volatility, but not the top, is very consistent of late cycle. And also divergent performance. This might be a little too technical, but divergent performance between various stock indices. In 2000, there was a period when NASDAQ started to sharply outperform Dow, and then it sharply underperformed. And we had this on a smaller scale, this type of price action this year as well. In fact, arrival of strong earnings and unambiguously strong economic numbers is also consistent with late cycle. This all happened in other cycles. The arrival of very strong inflation concerns that people claim was an argument that rates will continue to go up, like the very low unemployment, strong job growth, growth in average hourly earnings. All this stuff actually, which people see as an indication to higher rates, in the past led to much lower rates because that marked the end of the cycle in the past. Particularly interesting it is to observe the pattern in bonds. What I look at is, as always, as roll-adjusted classical bond futures, the long total return chart. Both of them had protracted backup. So in both previous cycles, there was a protracted backup in bonds, not just a sharp. There are many bond corrections over the last 25 years, probably at least 9. And most of them are sharp corrections with sharp recovery. Towards the end of the cycle, it was more of a protracted correction, often with double bottom, like recently, for example, in our market. And that is usually a precursor for a huge rally in the bonds. What is also interesting in the pattern of behavior, that this is the point, in the beginning of a tightening cycle, short-term interest rates go up, but the curve flattens and long-term interest rates don't budge for a while. At last, they're beginning to back up. And this is what we're seeing now. The curve is obviously flattening, but the rise in short-end interest rates actually managed to back up the rise in long-term interest rates a little bit. And that is actually, again, paradoxically, the sign of a late cycle. Every time that happened, we were close to the end of the cycle. That view was even backed up in the past by the weakness in dollar. And what is particularly interesting is that coordinated weakness of bonds, US Treasury bonds and dollar, which are typically negatively correlated, but that positive correlation, coordinated weakness, was also the sign of the end of last 2 hiking cycles. In the cycle of 99, 2000, dollar bottomed, dollar as measured by DXY index, which I don't love, but it's as good as anything else, It's bottomed in September 99, while bond futures bottomed around January 2000. In the cycle of 2007, it was slightly different order. Bond futures bottomed in somewhere in the summer of 2007, while dollar bottomed in February 2008. So the timing is not precise, and however, that kind of coordinated weakness, it's very particular to the end cycle. I think my inclination is that we did see the bottom in both bonds and dollar now, and we're beginning to bounce off this bottom. There is nothing really to prevent one or both of those things still making new lows. It would not negate my thesis. But the coordinated weakness is definitely the sign of the late cycle. And if anything, I wish I could foresee it, because when it started, I didn't yet know that we're in the late cycle. I know this is something I know now, but didn't know 6 months ago. The other interesting indicator that recently has been talked about a lot is a widening of LIBOR funds, Fed funds spread, or LIBOR OIS, as many people refer to it now. OIS is an old term, but we used to call it LIBOR Fed funds basis swap usually. It really blew out before the crisis in 2007. People are attributing some of the current widening to some technical considerations, but the reality is those considerations would be happening every tax season, but they're not happening now. They're happening now specifically, and that reflects the shortage of dollar funding, which is to be expected. Because not only we're increasing treasury issuance, sucking out dollars out of the system via growing debt, but we're also conducting quantitative tightening. And this is looping back to the important point I made earlier. I was talking about the fact that tightening is the concurrent necessity with regards to good economic performance. And right now we're in a situation that the bar is very high to stop the actual tightening. Because even if the Fed were to stop raising rates this year because of stock market volatility, I believe it would be very hard to stop the juggernaut of quantitative tightening, of Fed reducing the balance sheet and sucking $50 billion out of the system. And I think this is the missing link. A lot of people are saying that, oh, rates have not gone that high. Who cares about 2% rates? Those are still historically very low rates, and we're barely at positive real interest rates. For me, the important thing is that when you go from $80 billion per month of quantitative easing to $50 billion amount of quantitative tightening, that's the differential. That's probably worth several hundred basis points of easing or tightening on itself. So we actually went already to a much, much tighter environment. And if people disagreed with the fact that this is actually a tightening that is being felt, well, now we have a concrete argument that it actually is happening via tightening of the LIBOR funding. That added essentially one more hike, at least one more hike to the system. And this kind of widening of LIBOR fund spread is very consistent with the end of the cycle. And I believe, my personal opinion, and I used to trade this basis, by the way. I used to be one of the biggest market makers on this basis at the turn of the century. So I believe that the spread is not going to see much relief until we go back to easing environment. So this is going to be wide all the way till we roll over and ease a lot again and plateau again at close to zero interest rates, which is my central scenario. We currently have a lot of kind of preliminary indicators of possibly leading to recessionary conditions, but the view is yet not confirmed. I would say to really confirm the view, we need a real bear market in stocks. It's very hard for me to believe that recessionary conditions are in place until stocks equities develop a true bear market. But as I said, you don't want to miss, by the time equities are 30% down, you already missed a lot of action. You either lost money on those positions if you're a long-only person, or you missed the chance to be short, or you missed the chance to be long dollar bonds and long dollar, which, by the way, again, consistently with the beginnings of previous recessions, I would expect a very strong rally in dollar. What can you do now? You have to kind of wait a little bit. I still like long bonds a lot because I think flattening is relentless and sooner or later bonds will go up. But I would not touch yet the front end because I'm not sure what the Federal Reserve could easily hike 1 or 2 or 3 times this year. We just don't know what's going to happen in the front end. Probably the highest conviction right now is being long dollar against developed market currencies like euro and Swiss franc. I think the tide is very distinctively turning there. And European economy, while I'm talking with some ambiguity about those indications, in US, in Europe, they're screaming. They're wailing the indications of upcoming economic slowdown. I don't want to right now go into detail in European debate, but I think there is like a loud siren of economic slowdown in core Europe. When you look at all these charts that I talked about and indicators, they're not so consistent in a sense that even if it happened 2 or 3 times, some of them even apply to the previous cycle, the cycle of early 90s, but even if, for example, the oil price action too, but the timing is not consistent. It could be 6 months, even if everything I say is correct, the timing could be 6 months to recession, 1 year to recession, even 1.5 years to recession. I think being long dollar at this point is a very high probability trade, because if US rates keep rising, short-term rates keep rising, just the interest rate differential will eventually overwhelm any negative sentiment on the dollar. And if we're gonna, and the dollar shortage via quantitative tightening will keep working in your favor. And if we go into recession, it's very consistent with dollar rallying against euro, for example. I have to say I was probably somewhat surprised by the low FX volatility over the last few years. It seems to get kind of black swanny now. We basically have no volatility, and then something major like Swiss franc depegging happens. Or I remember like in December 2015, there was one day like a huge move on euro because of ECB disappointing or something. Stuff like that happens, and then there's just nothing. Same with fixed income. I think it is important to be vigilant that volatility is not dead, but it's hard to make volatility bets because you could be, say, being long gamma because you could be getting killed on gamma for 6 months straight. So I'm trying not to touch it and not to think about it. Yet in this current environment, I see some potential for using options. The good time to use options is when you have see a potential for a very big move in one direction, but also potential to be wrong by a lot. And if, for example, you're trying to project interest rates 2 or 3 years from now, I see potential of rates to go to zero again 2 years or 3 years from now, because we could be roll over, go into easing cycle a year and a half from now, and within a year they could get rates to zero again. But there is also a case to be made that rates could be at 4% 2 years from now. That case is also a valid case, and some people are making them, and they're not stupid. They have their numbers. I have my bias, but the people that hold opposite view have their numbers and their charts and their statistics too. So if you think of range 0 to 4% as a realistic range on 2-3 year horizon, that's a very wide range relative to current option pricing. So you may start looking at option structures to express your directional views if you feel that just say being outright long or being outright short if you have the opposite view is too vulnerable. I think every single signal in this framework has given many false signals and not necessarily led to a recession. I think the combination of signals I see is pretty strong, but it's important that I have a selection bias. I selected 15 maybe signals that are consistent with late cycle, but there are maybe another 15 signals which lead up to recession which have not happened yet. Like, for example, people really like to talk about ISM, manufacturing index turning down, which it has not. They're talking about inverted yield curve, which has not inverted yet. There is a whole number of things that have not happened yet. So I feel like the argument for late cycle is strong, but there is a certain level things are priced at. There is a certain level of public debate. I feel that my edge is my argument of concurrent necessity. This is what skews in my mind things towards late cycle. All the other things are what I call circumstantial evidence. They are not conclusive. They are just letting me to examine my view and see that a lot of things that people put counter to my view are actually supporting it instead of countering. or rather at least not doing anything. Like, for example, the rise in oil price. I don't think rise in oil price really means recession. Oil price going higher means by itself that recession is coming. But what it does mean, what it shows, it's not inconsistent with recession. There are certain things that would be inconsistent with this. For example, zero interest rates, if we still had interest rates really low, it would be historically inconsistent with arrival of recession. So the negative momentum on interest rates, the fact that interest rates have risen over the last 2 years, it's not necessarily by itself proves that a bear market in stocks is coming, but it's consistent with bear market of stocks. In stocks, for as long as we had positive momentum on bonds, there wouldn't be any precedent of a bear market in stocks over the last 30 years. So, for example, to call for a bear market in stocks in 2016 would be very unrealistic because it would be very inconsistent with interest rate indicators. But right now, a lot of obstacles to recession have been removed. So I would say it's not that recession is being proven, but obstacles are being removed. Well, if you're a person like myself who is worried about being in the late cycle, the most important thing what I found from the past is to be simple and liquid. Any kind of structured or liquid trades are difficult and dangerous in the late cycle. And I even had bad experience with some structured trades which were designed to take advantage of recession. Because as long as they're structured and liquid, you can run into all sorts of trouble because things not always move immediately in a rational way. I would be cautious right now about emerging markets because historically they don't perform well in recession environment. I definitely wouldn't be short anything because they have space to run up and they have positive carry, and I really don't like fighting the carry. Mostly I would try in this environment to stick to simple few ideas, which stick to trades which don't lose too much money if you're wrong, and stand to make a lot if you're right. This is why, for example, I like such simple trades as being short euro or short Swiss franc. You look at the euro over the course of next several years, how much can you lose on it? When the forward is about 150, so 10 years from now, euro is projected to be on the very upper range of where it has been over the last several decades. And it's not really trending against dollar, and the inflation is not trending in any direction strongly against dollar. So you should expect that euro should oscillate around 120, 125 for the coming decade. And if you have it right there, but the interest rate differential is so great, you have odds very strongly skewed in your favor. While if you try to play with emerging market currencies, which could just blow up, or conversely appreciate and cost you, like, if you take something like ruble, it could depreciate 30% in the next year, or it could just stay here and carry like 10% against you, which will just totally kill you. Those would be tough trades from my perspective. To summarize, I feel that we're entering a late business cycle stage. While there is some uncertainty about how late is late, whether we're talking dramatic turnaround is imminent or a year or two away, I feel still that the odds are very strongly skewed towards it being late rather than middle cycle. And hence, the position should be defensive on the risk assets. And there is a potential to take advantage of trades that perform well when the cycle turns. The trades that I mentioned, such as long dollar versus developed markets and long bonds. It still may be time to opportunistically look for some risk assets that don't have too much downside but perform well in the rising interest rate environment, because this is the environment we're still in, and there are assets that perform well in such environment. So it is a time to be patient, liquid, conserve your capital, and look for big payouts, but over the long run. And it is time not to put all your money on any kind of short-term prediction. However, so I would say like my 6-month confidence is very low right now. My 2-year confidence, 2 to 3 year confidence is fairly high.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.